So now we're going to look at those two non-discounting methods. So non-discounting methods means they do not include, they do not take into consideration the time value of money. We'll discuss the time value of money in the next video. So just know these two methods don't have it. Then we'll talk about what time value of money is. Then we'll look at the two methods that do take into consideration the time value of money. So payback is the easiest of the two methods, and payback is really just looking at how long it takes to recover or make back your initial investment, that down payment. So how long is it going to take you to get that down payment back? So we've got two scenarios that we're going to be working through with all four of these methods that we're looking at. So remember, we're Smart Touch Learning, and we've got $240,000 to invest. We have decided that we're looking at two different scenarios. We can either invest it in a B2B portal, and if we invested in that portal, we think that portal is going to save us $60,000 a year for 6 years. So in total, it's going to save us $360,000. I just want to point that out. It's going to cost us $240,000 and over a 6-year period save us $360,000. The next scenario, so payback is looking at taking the initial amount invested and just simply dividing it by that expected annual net cash inflow. Now remember, net means inflows minus outflows. So the net cash inflow is those inflows minus outflows. So in this scenario, it's that 60,000. So we're going to take our initial investment of 240 and divide it by that 60,000 net cash inflow. And we're going to get 4 years. So our payback period is 4 years. So what this tells us is that we're going to make back our initial investment in 4 years. Okay. Now, notice that payback doesn't tell us anything about any other cash flows. Like if we were told, oh, by the way, in year 3, you're going to have to do some maintenance on it. Well, payback doesn't look at that. Payback only looks at how long it takes to make the initial investment back. Now, the second scenario that we're looking at is also going to cost us $240,000. This is to upgrade our website. Now we think if we upgrade our website, it's going to bring in $80,000 of net cash inflow. So in other words, we think sales are going to increase and net cash inflow is going to increase by $80,000. So we can use the same formula for payback, the initial investment of $240 divided by the annual net cash inflows of $80. And we see that the payback for this investment is 3 years. So the website is going to earn its money back quicker, right? We're going to earn it back in 3 years instead of 4 years. But one thing I want to point out, notice that the website only has a 3-year life. After year 3, we're going to have to upgrade the website again. Whereas the B2B portal is going to last 6 years. In other words, 2 years after its payback period. Payback doesn't take that into consideration. Payback only is looking at how long is it going to take us to earn our initial investment. So the decision rule is that the shorter the payback period, the better. But again, you need to take other things into consideration. We need to take into consideration that, by the way, the website is only we're going to earn our money back and then we immediately have to spend more money. Whereas the B2B portal is going to give us 2 years after the payback period, after we've earned our initial investment back. But payback doesn't include that in its analysis. So that's something we've got to keep in mind. So notice that this is the accounting rate of return. The next method we're going to look at is the accounting rate of return or annual rate of return. But the accounting means we're not looking at cash flows. We're going to be looking at accounting dollars. So this is going to tell us or give us an idea, an approximation of the change that we can expect to see on our financial statements. So notice that our numerator is annual net operating income, average operating income, divided by the average amount invested. Now here's the thing, we usually don't have the average operating income. That's a GAAP number. That's based on accrual accounting. Accrual accounting says revenues are recorded when they are earned, not when cash is received, and expenses are recorded when they are incurred, not when cash is paid. So we usually don't have this number. We have how much cash is this going to save us and how much cash is this going to cost us. So we have the net cash inflow number. So we're going to have to approximate this numerator by saying annual net cash inflow minus annual depreciation expense. And I misspelled annual. So remember, depreciation expense is a non-cash expense. We take it out on our income statement, but it won't show up as a cash flow. We don't actually pay anybody for that. So we're going to have to calculate the depreciation expense and get our net cash inflow, subtract the two to approximate our annual operating income. Now, the denominator, the average amount invested, this is going to be that initial investment or the down payment plus the residual value or the salvage value. We use those two terms interchangeably. So the initial investment, so the amount that we have to pay at the beginning at time 0, plus the amount that we expect to receive at the end, divided by 2. And that's how we get the average investment. So let's go through and calculate this then for the two different scenarios. Now, I'm going to show you, this is the formula that your book uses to calculate ARR. You can use this formula if it makes more sense in your head. It's the same formula that I'm using. It's just written a little bit differently. I really don't like to use this formula. I think it's confusing, but if it makes more sense to you, then by all means, go ahead. So let's first look at the B2B portal. So we know that our annual net cash inflow is $60,000 per year. So we were given that. So we need to calculate the depreciation. So I'm going to write this up here. So straight line depreciation, remember we learned this back in financial accounting. Straight line depreciation is equal to the cost of the asset minus the residual value divided by the useful life. So in our scenario for the B2B portal, the cost was $240,000. The residual value is 0. They didn't tell you that. They didn't say the residual value is 0. If they don't tell you what the residual value is, you have to assume that it is 0. But if you think about it, it's a B2B portal. You're not going to sell it for anything at the end. And our useful life was, remember, 6 years. So 240 divided by 6 is, I believe, 40,000. So our depreciation expense would be 40,000 per year. So that means that our numerator then would be, pretend I didn't just show that to you, the 60,000 net cash inflow minus the 40,000 of depreciation expense, which is 20,000. Now our denominator is again that average amount invested, and so our average amount invested is our initial investment of 240 plus 0, which is our residual value, divided by 2. So in our case, that is $120,000. So we would calculate ARR by saying 20,000 divided by 120,000, which gives us 0.167, which is 16.7%. So this ARR is saying that we would expect to see net income, profit, increase by approximately, keep in mind this is an approximation, by approximately 16.7%. on our income statement. And then we've got that there. So our decision rule is that if the ARR meets or exceeds this required rate of return, the required rate of return is set by management. Management tells us, hey, this is how much that we think we want all investments to return at least 15%. So since the B2B portal did, we would invest. Since if ARR is less than that required rate of return, we would not invest. Now you'll notice that I don't have a slide on here for the website. Let's look real quick. I'm just going to write this up here at the top of our website. So we know that our ARR, our numerator is that net income, which is the net cash inflow of 80,000 minus the depreciation. So, all right, let me go over here and calculate straight line depreciation. So straight line depreciation is the 240,000 of initial investment minus the residual of 0 divided by the useful life, which is 3 years. So in this case, it is 80,000 per year. So my numerator over here would be 80,000 net cash inflow minus 80,000 of depreciation, which gives me 0 in the numerator. Now, we know that we can't divide by 0. You can't have 0 in the numerator. So the accounting rate of return for the website would actually be 0. Even though it was bringing in $80,000 of net income, net cash inflow every year, we're immediately writing that off. And so we would expect to see, or in terms of depreciation, so we would expect to see 0 change in our income statement. Now that's not necessarily a bad thing, right? The more net income you have, the more taxes you have to pay. Here we're getting $80,000 in cash flow off of this, and we're not having to pay any taxes on it. So, I mean, this isn't necessarily a bad thing, but it is we do need to know going in that, hey, if you're a manager, you need to warn the manager, hey, if we decide to go with the website, well, yes, it's going to bring in $80,000 of net cash flow every year. Just know that's not going to make our net income go up. And here's why, because that's immediately eaten up with depreciation, which saves us in taxes, but don't expect to see that boost in your income statement.